Hi, welcome to our latest edition of Credit Conversations. I'm Tracy Krepper, and I'm joined by Craig Lupton, our Head of Consumer Insights, and Becky Galvin, Business Consultant. We're here to talk about the latest in consumer credit trends, as well as regulatory requirements for borrowers in financial difficulty. Craig, can you tell us what's happening this quarter?
Yeah, so let's start off with the mortgage market. When we last spoke, we were starting to see the first sort of signs of recovery in the mortgage space, with applications coming back and a little bit of competitiveness in that market. We've subsequently seen a rate drop in the summer, so we're starting to see those rates starting to fall a little bit more activity coming back to the market. And we see this, so we currently see sort of 2/3 of the top 20 lenders in the mortgage space, and from the activity they're coming through our bureau, we can see that the levels of demand are increasing. Consumers are returning to market, there are more properties for sale on the market, there are more inquiries being made to estate agents, and we think that this is going to return the market to growth throughout the rest of this year. There is also on the horizon a potential another rate drop, which is also just going to impact and make things even better for consumers. There are still concerns around the affordability aspect of that, but we are starting to see the knock-on impact now. We've got consumers starting to roll off the elevated fixed rates onto potentially lower rates now as well. So that's starting to come through, and that'll come through stronger in 2025, which will put some cash into the back pockets of those consumers as well. So green signs of recovery, some opportunity there, and it's looking a little bit more confident in terms of the mortgage space.
That's from the borrower perspective. Becky, can you shed some light on what we're seeing from the lender perspective?
Well, it's pretty much the same story insofar as in terms of new lending, we're seeing a lot better volumes than we thought we would be in this position same time last year. So that's a positive. Lenders have adjusted their policy due to cost of living, and volumes are coming through. If we're looking at the back end, arrears have sort of stabilised more recently from a stock position, and that's really as a result of extended forbearance and some of the stress tests that the lenders have put in place. One area of concern is potentially terms in terms of the affordability. To meet affordability, consumers and lenders are extending terms to achieve that, and whilst not an immediate problem, that could potentially cause issues further down the line.
Thank you, Becky. So what are lenders doing to help facilitate growth?
Lenders are looking to use data to their competitive advantage, not just their own data, but sort of the whole data from the mortgage market to seek out new opportunities, to develop new products and explore new channels.
So what we're saying, Q3, there's opportunity for growth. We're seeing a increase in mortgage applications. Lenders are extending terms and helping facilitate that growth using additional data sets, looking at the whole of the market. There's definitely opportunity for the market growth continuing. We've talked about mortgages. Craig, what are you seeing in other product lines? How about cards specifically?
Yeah, so cards really continuing the phenomenal growth we've been seeing throughout the course of this year so far. So we spoke last time around, I think 1 in 12 adults has opened a credit card this year. We're now up to something like 1 in 9 adults have opened a card. It's phenomenal numbers of cards, and we don't foresee that ending. We're moving into a busy time for cards, so October, November tends to be, as we move into the festive period, a boom time there. So we think we're going to end up about 15-16% growth in terms of volumes of cards on there. Now, by value, it's very different. It's about 7%, 8% growth when we talk about the credit limits being assigned, and that kind of gives you an indication of where that lending's being done. It's being done in the more higher risk segments, and therefore lower credit lines being issued to those consumers that have tapped into that end of the market on there. But it's a phenomenal story, the growth that we see. I've not seen growth like that in the card space for such a long time.
So yeah, Craig, when I talk to lenders, we're seeing much the same story, slight relaxation in credit policy, but lenders are still really concerned about affordability, and particular focus on income verification at the moment as well.
Craig, what about the delinquency aspect?
Yeah, it's a good question, because obviously with the higher risk lending that's been done there, we would expect to see higher levels of arrears emerging from that cohort. Now, I've already spoke about the lower lines being done there, so there's less money being lent to those consumers. And what the knock-on impact of that is, we're starting to see, when we're not seeing breakout delinquency emergence from those cohorts of customers. Yes, it's higher risk. Yes, there are arrears rising from those consumers on there, but it's not alarming levels of there. And like I say, those are lesser lines that have been lent to those consumers. So again, it's not stretching the affordability aspect of those consumers significantly beyond their means. We're not talking credit lines of thousands of pounds, for example. So we talked about the credit card market quite heavily there, but we're also seeing growth in the personal loan space. Well, now it's slightly different to the cards market. It's across the spectrum, so we're seeing growth in £7,500 to £15,000 loans, but also we've got new entrants coming into the bottom end of that market, the lower end of that market, if you like, with sort of sub £2,500 loans. Again, meeting an appetite and a demand from consumers at that end of the market. And as we move into the sort of seasonal festive period, retail finance is starting to pick up and we're starting to see growth in that. And buy now, pay later continues to be a very favourite channel for consumers.
So we've talked about growth in the card market. Is there still more opportunity for lenders in this space?
Yeah, I mean, you'd think 7 million cards been done this year that may have exhausted the pot, but there are still people looking for cards. There are still consumers using the aggregator sites, coming to market, looking at the offers that are on there, and not clicking through. So that at both ends of the spectrum, we have consumers who are getting offers of product, but are deciding that that's not right for them at their particular time, and they are still out there looking for cards. Then at the other end of the spectrum, we have those that are arguably being excluded from credit. So they're coming to the market, they're looking for a card, but they're not getting a product. The appetite is not there from the lender, or quite rightly, they're not being shown a product on there. But yeah, to answer the question, there is still growth out there. There is still opportunity available to lenders, depending on their appetite, depending on where they want to go, and if they can make products meet the needs of those consumers.
Becky, from your perspective, what can lenders do? How should they be finding these opportunities?
The key comes down to data again, really. So lenders obviously have their own data to understand their own performance, have their own risk appetite, but using data from the full market can really provide additional insight into perhaps business that they didn't take on that succeeded elsewhere. So yeah, data and analytics is always the answer. It doesn't matter whether you're looking to increase conversion on your scorecards, for example, or enter a new market, or even perhaps look at your affordability strategy to see if that's are you being too conservative or not. It all comes down to using that data both on your own lender book and other lender portfolios to give you that insight to grow.
So Becky, on the topic of delinquency, what should lenders be doing in order to support consumers that could be potentially getting into financial difficulty?
That's a good question. Essentially, the regs on supporting borrowers in financial difficulty come into play very soon, so lenders will be well equipped on how to support them. The first element of the guidance is tailored support. So it's really important to engage with consumers early. You see a lot better recovery from those that you engage early with than those that have got into a bit of a pickle. And actually, if we look at that borrowers in financial difficulty definition, we've actually expanded that to include those that aren't yet in arrears. So lenders are going to have to work with pre-delinquency strategies in order to achieve that. The second area is transparency. So customers really need to understand the support that they're getting, and they need to not be handed off multiple times. They don't need to be told the same communication many times. So it's really important that that's achieved. And the third area is really treating vulnerable customers, providing the right support for them. That's really important and aligns to consumer duty. And then underpinning those three areas, it's really important to monitor regularly. And that's in terms of how you're managing those customers that are in potential financial or actual financial difficulty, and then also looking at how they're managing their accounts. Are there missed payments or other indicators that mean that you should take action?
How big of a problem is this? Tell me what it looks like from the UK landscape and from the market.
Yeah, so when we overlay these flags that Becky's been talking about across the UK population, you're looking at approximately 13% of the UK adult population would fall into one of these categories. Now, there are probably two sides to it. There is the more early delinquency warning signs, so you've got about 2.5 million consumers that would fall into that bucket. And then you've got a more severe, sort of harsher, later stage delinquency, arrangements, borrowing out of necessity, and you're probably looking at about 5 million or so adults in there. So not insignificant numbers that obviously require help and treatment from the lenders in the UK.
And I think that definition, the wider definition, has been done deliberately just so that we can pick up on those people that are on the cusp of delinquency. Well,
thank you, Craig and Becky. It's been very helpful. What we're hearing in Q3 is that there's definitely still opportunity for growth, specifically in mortgages and definitely in cards, that you have to make sure that you're continue to protect those vulnerable customers, especially as new regulations come into market. And third, make sure that you have a full market view to understand what's happening, not only in your portfolio, but in the market overall. I appreciate your time, and I look forward to seeing everybody again for our next credit conversation.